And so when the pandemic hit in 2020, you can see here in the 2020 quarterly analyses, there was a pretty strong collapse in Q2, Q3. And then we emerged from that in 2021 into one of the biggest M&A bull markets globally and in the US ever. It was a record year for everybody. Not surprising, some of the deal flow came from 2020 into 2021. We also had the prospect of tax law changes, which never occurred, which pulled a lot of deals into 2021 as well. And we started 2022 Q1 with expectations that we'd probably have a continuation of that market. But things never stay static. And obviously we had a war in Ukraine. We had supply chain issues, which were lingering from 2021. We had the emergence of inflation, which became very persistent and quite high, honestly. And all of that led to a decline in deal flow represented by the bars for Q1, Q2, and Q3. So this is our first slide on valuations. And this is a GF Data is a database that we use that focuses more on private equity owned businesses. But a couple of things here I want to point out is, first of all, size matters. And you can see the gray bar is the bigger deals, or are the bigger deals. And then the yellow is the smaller deals. And you can see the legend down below. And again, the markets that Prairie typically deals with are the yellow and the green bars.
The question to me has always been, and as far as you go back in time looking at this, it's always been this way. Smaller deals get valued lower than the bigger deals. Absolutely. The question is why? And I think it relates to your previous slide. The perceived business risk for the smaller companies is greater than the larger companies. So if any small businesses out there are listening, whatever you can do to lower the perceived and actual business risk will result in higher valuations.
But the private equity funds, the green bars have been pretty static in the middle sevens.
Yeah, but if we go back to 1990, they were more like 5.25.
Yeah, true. But I think deal valuations actually after the high yield bust and all that stuff changed a little. But that may be right. Yeah, it'd be an interesting topic to go back further and talk about that. But I think it's a good segue, John, into the next slide here. And that's really the changing composition of business ownership in the United States. And my interest was piqued on this by Jamie Dimon's, and forgive me for bringing up another bank here, Allison, but his shareholder letter, I think it was about a year ago now. And basically he was talking about private equity becoming a bigger component of business ownership in the country. And so I did a little research, and basically if you look at these companies, now first of all, let's look at the right-hand side. So approximately 33 million business enterprises are in the country. That's everything. Public, private equity, everybody, ESOPs.
Flower shops, dentist office, it's everything.
Yeah, it's everything from dry cleaners up to, Walmart or, some of the biggest public companies. But the composition is interesting. The first one, and this is now on the left-hand side, US Publix is less than 5,000 now.
Shocked, I saw that.
Yeah, and it's down from almost 10,000 5 years earlier. Wow. So keep in mind, what is going on here? Why are public companies not so popular anymore? And the answer, I think, is it's increasingly more regulatory. There are a lot of issues with public ownership. And there's just a giant deal machine called private equity, which has money. Yeah. And so we're not, the funds that we deal with, the lower middle market funds, they're not going to go buy Walmart. But maybe Blackstone will, or some of the very largest funds.
So John touched on this a little bit, where historically we've really seen kind of 50-50 debt to equity for private equity backed transactions. And I would say even last year we were getting asked more often 60-40 debt to equity. But we've seen a complete flip of that over the last couple months, where they're private equity is putting in 3/4 of the transaction. Because they still believe in kind of the value of the company. But this has been kind of a shocking eye-popping number. And I think that's just where it started, kind of, you saw it on the high yields, and then it trickled into kind of the senior unitranche type deals, this really fell off at the end of the year. Whereas kind of the below 20 million in EBITDA leverage market was flatter. But I do think kind of you're continuing to see the pressure there kind of going into Q1 of this year.